Adjustments to income are deductions you take before you even get to AGI. That's why they're called above the line. They reduce taxable income, but the bigger exam point is this: they also reduce AGI itself. And AGI is the gatekeeper number for a lot of credits, deductions, and phase-outs. On the EA exam, they love asking what lowering AGI unlocks. Here's the reporting location you need memorized. Adjustments to income show up on Form 1040, Schedule 1, on the Adjustments to Income section. Then the total flows back to Form 1040 and reduces income to arrive at AGI. If a question asks where an above-the-line deduction is reported, Schedule 1 is usually the answer. Don't confuse above the line with below the line. Above the line means it reduces AGI. Below the line means it happens after AGI, like itemized deductions or the qualified business income deduction. Exam tip: if the question is really about eligibility for a credit, they're usually pushing you to think about AGI or modified AGI, so above-the-line deductions can change the outcome. Why does lowering AGI matter so much? Because many tax benefits phase out as AGI rises. Lower AGI can increase or restore eligibility for certain credits and deductions, and sometimes increases the amount you can claim. So an adjustment can create a double benefit. It reduces taxable income directly, and it can improve the math on other parts of the return that depend on AGI. Now the AMT twist. A lot of deductions get limited or added back when computing alternative minimum tax. But adjustments to income are generally not added back for AMT, the way some itemized deductions are. On the EA exam, watch for wording like preference item or AMT adjustment. They're testing whether you know what gets pulled back into income under AMT rules. Nadia and Ethan are married filing jointly. Their joint AGI is $88,000 in 2023. Nadia paid $2,650 of student loan interest, and Ethan paid $4,900 on his loan. What is the maximum student loan interest deduction they can claim on their joint return? Options include $5,000, $2,000, $2,500, or $7,550. Think about it. The answer is $2,500. The student loan interest deduction is capped at $2,500 per return per year, not per person. The tempting wrong answer is $5,000, because you might think each spouse gets a separate cap, but on a joint return, it's one combined limit, so they top out at $2,500 total. Which of the following would not be part of the computation of alternative minimum tax? Choices include depletion, self-employment tax, certain state and local taxes, and interest on private activity bonds. Think about what AMT is actually adjusting and recomputing. The answer is self-employment tax. AMT is a parallel income tax calculation that starts with taxable income and then adjusts for AMT items and preference items to get AMTI. Self-employment tax is a separate tax computed outside the AMT system. A tempting wrong choice is state and local taxes, because they're disallowed for AMT, but that's exactly why they're part of the AMT computation.